In India, mis-selling happens for every single financial product. Auto drivers putting 5,000 rupees, 10,000 rupees and losing money. For a retail investor, getting into a private market is extremely risky.
If you look at the shareholding structures in companies, a lot of the companies which are the 2008, 9, 10 vintage, the first check would be an institutional investor.
I've been that employee. I didn't get ESOPs. I actually bought shares and I could not sell it. And the company was run down to zero. So I'm technically worth zero.
The complexity of the cap table is a problem in India. Compliance on issuance of shares is a problem in India.
We are trying to solve that problem by kind of giving some sort of a line to the founders. Here's the money, X amount of capital available for you for the next 4 months at an agreed valuation. You figure out what formula that you want to use with your employees and provide them some sort of liquidity.
Zerodha, do you think they should list?
I think the whole market is waiting for them to list.
As long as the business is continuing the way it's continuing, I think they shouldn't list.
Rainmatter invests in fintech startups with the intention of investors doing better with their money, which we believe will also help deepen markets in India. Join us as we speak with the startups and venture capitalists who invest in them about how they are approaching markets, fintech solutions, in all subsectors of lending, payments, investments, insurance, and infrastructure, as well as their businesses from scratch.
Hello and welcome to another episode of From Scratch. I'm Hansi and today we have as guests Satish and Srini from Hissa. Welcome.
Thank you.
Thank you.
Before we dive deeper into what you're trying to solve, maybe give a very brief introduction on what Hissa is.
So Hissa, as you probably know in most Indian languages, means a share. What we are trying to build is a equity management platform which deals in shares for private markets. So essentially, that's a very broad overview of what we do. And then you have products, problems, services, and so on and so forth under that.
Okay. And how long have you had this company?
We are little over 5 years now, all the way from ideation to where we are today.
What exactly was the problem that you were seeing at the time that you think led to you setting this up?
Well, I think the fundamental problem the fundamental stuff that we looked at was the changing nature of private companies in general all over the world, right? Because almost all private companies, and when I say private companies, largely we talk about the venture-backed private companies, right? Or the startup world. Typically, 4 or 5 years is what would take to, get a good company out. And a lot of structures, a lot of mechanisms, a lot of processes followed that route. But if you look at the last 15 years, pretty much the amount of time it takes to build a company of some value, and I'm not associating a number with that, but some value is literally 10 plus years. Now, if you look at all the stakeholders who are part of that, it's not possible for everyone to lock in their wealth for 10 plus years. So we saw that this private market now, which typically used to last, private companies which would typically take 4 or 5 years to grow, are taking a lot longer. But there are stakeholders whose wealth is locked in. And so something needs to change, here. And that's the larger problem that we saw. And then we went about solving it in ways that we thought was relevant.
You have a background in venture capital as well, right?
Yeah.
I remember when I brought Mercer to India in 2008, that was kind of like still in the early days of venture capital, and then we kind of lost a lot of money, and then now we're kind of sort of second phase. Maybe perhaps give a bit of background on what you saw there and how in terms of company building, how India has changed, the environment has changed.
Well, from the venture segment, this is what I would call probably the third wave of venture capital in India, right? The first one was, the famed ICICI-driven late 90s type of venture capital. And post 2008-9, the new age or the US venture capital setting up shop, getting funding, lot of the Indian companies who now have turned out to be really, really big. If you look at Axel, Sequoia, Lightspeed, and likes of Flipkart and so on, all came through that 2008-9, wave. Now, 2017 or so, we have a lot more structured venture capital ecosystem where you have a lot of seed funds, a lot of angel networks, and homegrown, VC funds, growth funds, and so on, right? So I think from a venture capital perspective, I think we are probably at the most mature stage in terms of how that wave has spread out. So for your point in terms about everybody who invested in 2008 has not made money. That's the very early stage of the industry here as well, right? So I think the growth has been fairly positive from a venture ecosystem. There are sector funds, and there are all sorts of funds, and that's a sign of a maturing market, in my opinion.
And 2008, do you think it was only a matter of overvaluation, or do you think there were other factors?
No, not at all.
I just add to what Satish said. If you look at the shareholding structures in companies, a lot of the companies which are the 2008, 9, 10 vintage, the first check would be an institutional investor. Very often you don't have an angel investor on the cap table, and even if there's an angel investor, it's a small check, and straight away you go to what you call a Series A round. But when you look at any cap table today, there are friends and family, there are angels, there are institutional angels, there are seed rounds. There's a lot of stuff which happens before your what you call your Series A or Series B round, and that is a sign of the maturing ecosystem. And the other thing which is happening is a lot of people who have made money off this ecosystem are reinvesting into the ecosystem. So you look at the founders. The founders are the most active angels in India. So that to me is a sign of what Satish just said, that the ecosystem has evolved so much. And when the ecosystem has evolved as much as it has, it's got extremely complicated as well. So when you organize those markets, first you ensure that the value of that system goes up, the entire ecosystem goes up, and it works in a fair manner to everybody who's taking risk, right? If you look at the cap tables, you have founders, you have angels, you have what you call micro VCs, then you have the regular venture capitalists, you have the employees, you have the venture debt providers. That complexity sort of does not by itself, in a natural sort of way, ensure fairness to everybody, because everybody is looking to protect their own rights, their own interests, and that creates a little bit of a complex and conflicting situation.
Another sort of observation is that back in 2008, there weren't as many players. You said the first check was institutional, and
very often,
and there would be this rush to IPO. That was kind of the main thing. Here now, companies are staying private for longer, and this is not just an Indian phenomenon, right? Because there are, as you said, many more stages. There's angels, there's friends and family, there's Series A, B, C, D, whatever it goes on. Is that a good thing? I mean, the fact that companies are staying private longer, I guess there's a reason why companies go public. There's a price discovery that happens in public markets. There's a broader shareholding that happens. A lot more people participate in the markets. So there's a whole reason why companies go public. Why are companies staying private longer? Any thoughts?
I think, fundamentally there's nothing wrong in companies staying private longer, right? Ultimately, whether you're a public company or a private company, you've got to do good by your shareholders. If your shareholders are public, then you have a lot more scrutiny, you have a lot more regulations, and so on and so forth. And the fact that you've gone public and that has brought liquidity into your primary asset, which is your own shares, creates a little bit of a different kind of vibrancy in the entire asset class, right? But staying private longer, if the capital is available, right form of capital, right structure, there is absolutely nothing wrong. And I think what everybody is figuring out now is it does take a lot more time, to get to some sort of a scale which you can reasonably say is it a stage where you've kind of made a position in the segment that you're operating. Maybe you're not, whether you're number one, number two, number three, in that sector you've taken a position. And this tremendous amount of capital has enabled you to do that. Maybe listing too soon may not let you do that. And again, this has been our constant venture capital bashing, right? You focus on growth, nobody focuses on profitability. If you're forced to go public, and given the way Indian regulations are, you will focus on profitability at some point in time. So it's a better way to build companies that are profitable as quickly as possible. And I don't think there is one right, what's the other, but it's more of, would I benefit by having capital, lesser scrutiny in terms of how I want to look at quarter-on-quarter growth versus taking a look at it as a growth for an 18-month period. And as a founder, I would love that 18-month period flexibility, you know.
But if you need capital, you're taking capital from VCs, and the VCs get it from pension funds or other investors. So it's not like, I mean, it is in the end retail investor money that is funding your growth, right? Isn't it better to do it with public scrutiny, given that it is retail money after all, than in the private sort of arena where you could have something, I'm going to use an example now, something like a Baiju, right? Where valuations can get so out of hand, or a globally WeWork or something. Valuation can get so out of hand for very long periods of time before sort of reality.
That's exactly the flip side of this.
Exactly, that's what I'm saying.
Where you will end up, you will end up in situations like that. You will have, and even today, you know, all of us believe, though, you know, we may not agree to the same degree, that private market valuations are a little out of whack even after all the corrections and so on, right? I think if you tend to look at this from a growth versus profitability, I don't think you will get to the right answer. It's about what kind of growth. See, public markets, you know, and again, there's this concept in the US called long-term stock exchange, right? The whole idea is that how do I make companies, listed companies, not really focus so much on quarter-on-quarter growth, because your management compensation is linked to that. You know, your share prices crash if there's a small deviation in your, you know, quarter-on-quarter growth. I think it's way too much pressure when you are building a solution or solving a problem that's not been solved before. If it's a mature market, you know, where your gross margins mechanisms are already in place, you have comparables and so on and so forth, you can argue that it's better to be a listed, you know, company, because then you're driving towards very specific profitability and you have benchmarks that will help you get there.
But it didn't stop Amazon from listing way too early.
So if you look at that batch, the Amazon, the Googles of the world, you know, just before the millennium, right? I think that's the model I was talking about. The idea was that in 4 years, have you got to a point where I can list? If that's the case, then you go public, right? So the entire model was based on that, because if you look at company not getting anywhere in 4 or 5 years, generally it was considered that, hey, everybody should move on, that something has not kind of worked, right? I think it's all that environment has changed. Even if you look at somebody like Meta, you know, Meta went IPO a lot later than some of these companies, right? It was not 15 years as it is now, but I think it was 8-9 years, you know, something of that kind. So progressively, it's taking longer and longer. So there is some merit in it. No.
See, while it's retail money on both sides, in theory, in a stock exchange, the retail money, the retail investors making his decisions himself to either write a check or to exit, right? Whereas when it's an institutional investor like a hedge fund or a, you know, even if it's retail money coming through those funds, the decision is in theory made by a sophisticated investor. That's a key difference between the two. That's one thing. Second thing, you know, at least the way the Indian regulator looks at it, I like to use the word enterprise. You need to be an enterprise in the true sense of the term to be able to list. If you're not an enterprise, you should not be listing, because enterprise essentially means more certainty, you know, more predictability, you know, more better governance standards, better structure to everything that the enterprise does, right? If you look at the you know, the generation of companies in India that listed before the current wave of startups did, you know, they had you know, valuations are largely linked to your balance sheet or your P&L. In a startup, that's not the case. You know, companies can be loss-making and still list. So I think those are some of the factors which are playing out on timing of listing as well. And now there are disruptive events happening all the time. So boards are also not ready to say, are we certain that this company can, you know, hold its ground for the next 3, 4, or 5 years? If you're not able to do that, are you ready to truly list?
Zirudha, I mean, do you think they should list?
I think the whole market is waiting for them to list. No, I think it's a very personal choice.
I mean, I know they don't need capital, and therefore they're free not to list.
See, if I've raised money from investors, I have a responsibility to create a liquidity event for them, in which case I have to list. When I'm not raised money from the markets, when I've grown organically, I don't have that responsibility to list. So I think it's completely up to the founders. See, listing is necessary from an investor standpoint.
I think they shouldn't list, if you ask me. In a straight answer, I think as long as the business is continuing the way it's continuing, I think they shouldn't list.
So I guess, as you said, there are a couple of things. One is the ESOPs to employees, and they've done the buyback, so there also that issue is not there.
Correct.
But assuming that was a bigger thing and they didn't want to do the buyback, that could be an interesting sort of point.
Absolutely.
Liquidity for sort of early employees and investors.
Any stakeholders.
The argument that Nitin gave was that he wanted the company to be more diversified, the revenues to be more diversified, so that retail investors don't buy in a retail stockbroking company and then tomorrow realize that half the revenues are gone, which could happen, right?
Could happen anytime.
But to me, every company runs that risk. So every company
Absolutely.
can't be a conglomerate, can't be diversified. So I did push back on that argument. I still do push back on that argument. He doesn't have to listen to me, but you agree with me, right? So on that front, it doesn't make sense.
See, I think like I said, the listing is one liquidity event. So if you have external stakeholders or even internal stakeholders like employees, right? As long as you have a healthy mechanism by which, there is participative capitalism and they get to see the benefits of what they've been doing, then really no need,
By staying private, the argument then goes that retail investors are missing out on the growth of all this wealth that is being created by these companies. And therefore, to participate, the venture capital funds need an allocation from pension funds. So there's a whole industry of VCs that are going to the PFRDA and saying, please allocate to alternative
And that's how the US markets have grown.
And therefore yes, and that's what Australia has done as well. Any thoughts there?
So if you ask me, for a retail investor, getting into a private market is extremely risky. So now, do you want to expose them to that asset class at all? I mean, I could make the same argument, why stop crypto? We have heard stories about auto drivers putting 5,000 rupees, 10,000 rupees in some, useless coin and losing money, until the recent regulations came where they cut the ads on all the exchanges, right? So in India, mis-selling happens for every single financial product, including stocks, mutual funds, and even insurance, right?
Even real estate for that matter.
No, real estate is by definition considered illiquid, right?
No, but there's mis-selling happening there. Mis-selling happens in every form.
But small amounts. I'm talking about retail investors. So retail investors, I think until the system is a lot more vibrant.
What do you mean by that? What do you define vibrancy?
So vibrancy is like, for example, if you look at the concept of accredited investors, right? Now, if you build that in a way where it's probably not directly linked to the amount of capital from a net worth perspective, but more of what percentage of your net worth is allowed to invest into private markets. And you can kind of break that down in many phases, right? The situation here is, it's a very, very embryonic asset class, highly risky. Do you want to expose that to somebody who does not understand the nuances of it? And in India, I think, to me, I believe that you shouldn't, because there are other financial products which are probably a lot more safer, which have still not been exposed. I mean, the entire bond market is, not really into the retail segment at all, right? Even stocks, direct equity, or even mutual funds. I don't know what is our percentage, like 8% or something like that is the public market stuff. So there are tools in terms of assets that are available where you can make money, and you can make tremendous amount of money. I think exposing them to private markets where you have this valuation bubble all the time, no matter what people say, up market, down market, there are always companies which are overvalued, right? I think it's too much of a risk. So to me, I would say until we get to a point where there is at least 20% penetration in the public markets, the current regulations in terms of how the unlisted space is going on with respect to retail investors, I think that's absolutely fine. I'm personally definitely not in favor of get somebody's 10,000 rupees and put that in a startup.
So really there's 2 pools or 3 pools of capital. One is the high net worth individuals in India, which they are a growing number.
Absolutely.
There is the government supported sort of funds, and then there's overseas money, whether directly or indirectly, coming via AIFs. And we need that capital, right?
Correct.
India needs the extra capital to grow. let's now sort of turn to your sort of company and your products and services. Explain how you tie into this ecosystem and what you do.
So, like I mentioned in the beginning, the key driver for us is that private companies are staying private longer. So let's take every single stakeholder group in a private company, right? If it's an employee, if the company is going to take 10 plus years, and let's say you are in your mid-20s and join this startup, and you stay there for 10 years and you don't get liquidity, that's your pretty much most productive professional life as an individual, right? And you don't make anything out of that company. These individuals will never join startups. Take angel investors. Like Srini mentioned earlier, a lot of this money in all of these newer asset classes tends to rotate, right? So I put in $100, I made 180. I'll keep 30. I'll put 150 back in again. So for that vibrancy to happen, angels who've been supporting, taking a lot of risk, and these are professional angels, right? Not friends and family. Friends and family, you can say, hey, let's try next time, right? Professional angels, angel groups, angel networks, they need some sort of an exit. And lately now, given that our AIF structure is more than 13, 14 years old, and funds have a 10-year life, even early stage funds needs to exit.
Why do funds have a 10-year life? I mean, this is a very unique thing in India. It doesn't happen elsewhere.
No. It's almost everywhere there is a 10-year life. I mean, some of the countries have ability to do permanent capital a lot more easily. Even in India, as far as I know, SEBI doesn't restrict you. SEBI asks you, what is your fund life? If you say this is your fund life, then stick to it. So most copied the international model of 10 years, right? And said, hey, 10 saal mein to ho jayega.
Yeah, and if I go and say 20 years, SEBI will not have a problem, but my investors will have a problem.
So you have this combinational thing of, regulatory issues are there when you've crossed your timeline and you're asking for an extension and the regulator doesn't see merit in giving you an extension. But no matter what, if the company stays private 10 years, you have almost every single asset class, ESOPs, which are employees, early angels, and VC funds, need a liquidity event. Now, if the company is not ready for an IPO, what do you do? So we kind of took off from there and said, let's figure out how to build liquidity for private markets. And that's where the original thought process started, right? In some ways, privately, we would call internally when we would talk, we'll say, hey, we want to be the NSE of private market and so on, right? Not really an exchange, but the idea was to provide, some sort of liquidity. Then we kind of looked at stuff and said, hey, everything is done on pen and paper. Multiple law firms get involved for a small transaction. Nothing closes in less than 60 days. So it's not going to be possible without building
60 days
tech.
is very optimistic.
Right? So we said, okay, there's no tech. Now we have to build tech. So that's the first phase. We build the equity management software layer, which essentially manages the cap table of a company, which includes ESOP. So there are several other participants, that are part of that. So that's the first phase of the company where we said, okay, we'll build the software, have companies and VC firms adopt it.
And what's the tech component of that? Like, why is that a tech problem? I mean, why can't we just do that in Excel?
I think you can do it on Excel when you're in your very early stages, and he alluded to the fact that the structures are complicated, right? Today you have priced rounds, non-priced rounds, equity, CCPS, debentures, even debentures, convertible NCDs, safe rounds, all sorts of stuff.
Terms, right? Series A, Series B, Series C. Each series has its own set of rights. So by the time you get to Series A, there are 4 rounds. There's a seed round, there's an angel round, there are some warrants. So when you look at a cap table of a company which is 7 years old, you will have 23 different instruments sometimes. And the relative rights of those instruments, you can capture it on Excel. We've done it in the past before the platforms were available. But it required a lot of sophistication to manage those things on Excel. And it is just not worthwhile.
And time consuming. Fundamentally time consuming, right?
Inherently prone to errors because it is so complicated. So unless you have somebody really smart managing that Excel sheet for you, there can be a lot of errors.
And if there was an error, would then someone have to go and sue someone else to go and get their money back?
People never sue each other in these scenarios. It just takes time to, sort it out, resolve it.
Yeah, I think
if you don't resolve it, everybody's going to lose value.
At some due diligence, it's going to come and say, hey, what happened here? 2 shares missing, some money not returned back, through RBI route. You have all this stuff, right? And law firms and lawyers have been managing it. It's managed manually, and that's largely why it takes so much time. So we thought we have to build a liquidity layer, and if you tell an employee, hey, okay, I'm going to give you this liquidity, but it's going to be available in 3 months' time because you have this mountain of paperwork to do, and I will do DD on you and this and that. That's no, that's no platform.
And going back to public markets again, at the end of the day, if I own stock in the public markets, I can collateralize it. I can get liquidity whenever I want. Price discovery is made by somebody else, and it's done in an institutional, organized, structured manner. Whereas in the private markets, while you have value, everybody knows what the net value of that enterprise is. You always talk of discounts, employees giving discounts to sell their shares, angels giving discounts to sell their shares. They're not able to collateralize it. They want to sell, nobody supports them with diligence. So the market is quite not vibrant. Now, if you organize the market, there is better value for everybody on the table.
Right. So your platform is basically a cap table and ESOP management platform, right?
We will call it an equity management platform.
Okay.
For the company, it's managing the cap table. For the investor, it's managing, their shareholding and their rights. For an employee, it's managing their vesting and their, all the.
But convertible debt and all that stuff can sit on it.
Yeah,
I mean, we say equity management, there's no.
No. Everything,
okay,
almost.
fine.
Yeah, when you say
even options are equity at the end of the day. So
that's
it's,
all.
yeah.
So that's that, and that's the main product.
I'll give you a public market equivalent, right? I mean, all of us are familiar with the brokers and the exchanges, right? But if you leave these 2 entities out, you have the depositories, which is CDSL and NSDL, right? Then you have the RTAs, the big ones being CAMS and KFintech and so on. And then you have the clearing houses. See, if all of these did not exist, there is no way you could do the transaction the way we do in the listed markets. The depository is nothing but a cap table depository, so to speak. It's holding who owns what shares and so on.
Sort of certifies the cap table.
So you're like you're a depository for private markets.
So we are a depository, clearing house, RTA, everything for the private markets.
And what's the difference among these? I mean, as you say, some only do software. Do you do legal work? Do you do transaction? I mean, give us a picture of what your product compete against.
So, okay. So let's kind of break this down, right? So any private market transaction essentially has got a bunch of things. There is due diligence on the company or in our sense, I'll call it due diligence on the cap table, right? There's a larger business due diligence that we don't, get into. There is actually transaction management. You have the shareholder agreements, or subscription agreements, drafting those, negotiating with each one of these, lawyers. If there are multiple investors, there may be multiple lawyers. There are these closings. India is a unique place where there are regulatory backstops in quite a few places for good reasons, right? So moment the shareholder agreement is signed, you need to go file some documents with the registrar of companies saying, hey, this is what happened, this is the share price, this is in investors.
Even for a private company.
Yeah. And then now...
Unlike most other countries, the shareholding data is public data in India.
I noticed that, but that's not the case elsewhere?
It's in Singapore it is. In the US, there's limited stuff, but most of them, companies can get exempted under a particular rule, and they get exempted, and they don't file.
Right. So, but there are databases in India that have all these private companies on the database, right?
No, the database is derived from the public sources.
Correct. Right.
Usually it's the MCA.
Understood.
Yeah.
The MCA's data is public.
Yeah.
And the databases download it and...
Okay. So what I'm saying is that there are databases with private companies. Now, coming back to your product, what all do you do?
So there is this closing that I was talking about, right? Which requires filing of documents. So all of the entire thing is managed on the platform. Normally, when you look at, the difference between us and a lot of companies in this space is that we didn't look at this as a software solution alone. You may have heard of this company called Katta, which is the largest cap table management, equity management company in the world, right? So the US market is very deep in terms of number of companies who are venture funded, number of companies who are getting established and getting funded, and so on and so forth. So I think there is probably a play to build a software-only company where you just manage the cap table and nothing else. And US also, though they have a depository system, the system is not like what he was talking about, right? So Katta today, just being a software-only company and doing a little bit of valuations that support each transaction and so on, is about $350 million in ARR. That's not a small company by any means, right? So I think in India, to have that kind of an impact, the number of funded companies, which is about 25,000 today, needs to probably go 10 times. It'll get there someday, right? So most people ended up building these companies as, hey, like the Katta for India type, right? Some of them are doing okay, some of them have closed, and so on. We always saw this as a means to an end, which is to provide liquidity. Now, if somebody like Katta was already in there, then I wouldn't have even built the tech. I said, okay, we'll partner with these guys and we'll build our layers.
So Katta was not available in India?
Katta was not available in India, not focused in India. I mean, Indian nuances, like he can explain, right? Very, very different compared to US,
No, so while the basic meaning of the word share is the same, the process for issuance of shares, the process of rights, everything is substantially different.
Give us an example.
A very dumb example I can give is, legally speaking, a preference share is actually inferior to an equity share. In the US, a preferred share is actually superior to an equity share. So we've contractually made a preference share in India superior to an equity share, and that contractual, it's a valid contract. The law recognizes that contract. Now, some of these nuances are very, very different from the US. See, anytime you build a business, you solve problems, right? What is the problem in India? The complexity of the cap table is a problem in India. Compliance on issuance of shares is a problem in India. There's just way too much compliances that you need to do before and after a share issuance. You have a non-resident shareholder, you have to file with RBI. Every single issuance has to be filed with the ROC in India. And before you issue shares to third parties, there's a process where you file with the government, with the ROC, even before you issue the share. And the history of the cap table is captured in all these filings. So this essentially means that if you want to build a transaction layer, there are complex contracts which get negotiated, and that negotiation can go on for months. So if you have a sophisticated software platform, you can build a transaction engine on top of that. So the idea of building the software, like Satish said, was only because we can build the transaction layer on top of that software layer.
Okay. So have you done that now? Are you done with the software layer?
Yeah. Software layer is
I mean, it'll be permanently improving, right?
Of course.
But it's done.
So the software layer is done. And where are you up to with the transaction layer?
So transaction partly again is software and partly services. So we have a legal and secretarial team that does a little bit of the manual work that needs to get done, even though there's software, right? Like, for example, the reason I was giving you the listed company stuff is there's really no manual activity that takes place. From the time a user places an order, on your broker's terminal to everything that comes to final settlement. I mean, there are some backstops. That's why it's still T+2 or, whatever, right? But everything is fundamentally driven by tech. Like the example here of filing with an ROC. ROC does not give you any APIs. So which means somebody has to physically file a form with the ROC, right? So for that, and to help companies manage their transaction faster, we do have a legal and secretarial team. That's the services part of it. Now what we are building is the liquidity layer. And again, liquidity layer, there are two ways you can build. One, function like a marketplace, though there is technically no concept of a marketplace in this, right? Because anything, today, according to company's law, you can't go to more than X number of shareholders, then you would be deemed a public company. So you can't do it on a marketplace or a digital platform, as such. So what we looked at was, do we go build some sort of a curated internal marketplace, versus something else? So with some of our customers, we did the marketplace mechanism where they wanted to do ESOP buybacks for their employees. We sourced the funds from third-party investors. But increasingly, it became clear to us that we need to seed this with our own fund. So we now have the Hissa fund, which is specific for ESOP liquidity, SEBI-registered fund, where we actually provide the liquidity. So typically in a marketplace, you're connecting buyers and sellers, but we are the buyer here. And I think that's a key differentiator with how everybody is tending to look at this, saying, hey, I'll connect the buyer and seller, and then I'm out of it.
Do you have the marketplace as well as the fund?
Marketplace, it's not really developed the way a true marketplace would be. And I would argue that nobody has a marketplace yet because, one, there needs to be some regulations that can actually support it. Today, people are taking edgy views. And one thing we know though generally I'm a firm believer that innovation is ahead of regulation. When it comes to financial services, you better be careful.
It is, but I mean, can't you go and speak to the regulator? I thought from time to time they offer sandboxes.
The regulator will be open to a lot of these things.
You're solving a pain point here. So you go to the regulator and say, this is what you're building.
We are having that conversation. The regulators actually has allowed a few things in a very early stage market, which is not liquidity friendly, but more of investment friendly. So if, let's say, there's an angel wants to invest some money into a company, then you can pool angels to these angel fund structures. There are sub-schemes. So SEBI has actually created a structure.
There's an angel fund?
Yeah, there's a concept of an angel fund.
There's a concept of an angel fund. We are not an angel fund. We are a proper Cat 2, AIF.
VC.
Yeah, VC. Typical
like fund
is
fundamentally where the investor can decide, though it's a fund, each investor decides where the check goes. So you'll have, let's say, 500 angels signed up with you.
It's not a blind pool, the way we call it.
Okay. So as a manager, you bring a bunch of assets. Each investor decides which asset they want to put money into, and you create a separate sub-scheme for that.
Scheme, okay. I was going to say, what is the legal structure? Is it a syndicate?
It's a scheme. It's called a scheme.
Okay.
And that scheme will only have investors who have committed to put money there and have actually written the checks for that asset.
Under the AIF? This is all under the AIF?
It's also an AIF.
Correct. It's an angel fund AIF. They
That's
call it.
It's Cat 1?
No, it's not. It's a separate.
It's Cat 1. It's Cat 1.
It's Cat 1, right? Because VC falls under Cat 1.
Category 1 has 3-4 categories. One of them is an angel fund. See, the other thing is, we were talking about the software layer, right? Again, taking off on what Satish said, in the public markets, I don't need any agreements. So I want to buy shares that you own in LIC. Okay, the trade is booked through the broker. You don't have any agreement. You deliver your stock. It gets collected by my depository, put into my account, so to speak. But in the private markets, there are agreements which are signed amongst the shareholders of the company. That shareholder agreement needs negotiation because there are no standards.
Why are there no standards? Or can you set standards? Like, can you standardize the agreement so
that's one of the things we are working hard on. A lot of the funds want standardization. A lot of the founders want standardization. Because there is no standardization, it's a free for all today. Everybody can say what they want. Anybody can say what is standard. It almost becomes whose imagination is more creative when you negotiate these documents. So US has standards. The Indian industry is moving towards standards, and we're in the midst of helping the industry build those standards.
When you say industry, who does that? Someone like the IBCA?
We're not working with the IBCA. We are working directly with the funds, the Accels of the world, the Lightspeeds, all of them. We are working with them to build standards on one side. We are also talking to a bunch of founders, to say that, if the lead founders say that we think this is a good document, a lot of the new founders will say, okay, if individual A, if Nitin Kamath, for instance, says, I would blindly sign this document if it's in this form, it's going to really help the industry. So putting those standards together, having the software where transactions can happen in an automated way is actually key to build the marketplace finally. Otherwise, every single trade will go off the marketplace, right?
So right now your marketplace is still a work in progress, whereas the fund is taking precedence because it's cleaner. It's cleaner. Fund is live. How much money have you raised?
So the fund is a 300 crore fund, 150 plus a green shoe of 150. We've not completed the fundraise. We're in the process. The first close of the fund will happen in less than a week.
Okay.
But we've already made an investment. One investment is already made. So I think within the next 6 to 9 months, the fund will get closed, and within the next 18 months, it will get deployed.
Okay. So just to clarify, you have 3 services. One is the software, which is the equity management layer. Second is the marketplace, which is evolving. And third is the fund, where you've started the fundraise. And So you're encouraging investors, AIF investors, to then pick up the stakes in the private companies, right?
The fund is specifically for ESOP liquidity. So we are raising that just like any other VC would do, largely from HNIs, because the fund size is a little too small for a large pension fund or an institutional investor to come in. So, and also this is the first of its kind from a fund perspective as well.
So it's not giving liquidity to a VC, it's only giving liquidity to ESOPs.
Exactly.
Okay, so specifically ESOPs.
Specifically.
Now, just clarify, the companies have to allow ESOPs to be sold to a third party.
Correct.
Do most companies in India allow that?
So by definition or by default, no. The company has to authorize this entire process. And the way we are trying to solve that problem is by kind of giving some sort of a line to the founders, the company, right? We're saying, okay, here's the money, X amount of capital available for you for the next 4 months at an agreed valuation. You figure out what formula that you want to use with your employees and provide them some sort of liquidity over the next 4 months. So some of our customers want to do it every month for these 4 months, right? So I will decide saying, maybe I will limit it to 20% of the vested options, capped to a certain amount.
Hang on, so you're giving the line to the company as opposed to buying out the employees' shares?
No. Okay, there's a little nuance to it. That's why I said like a line. It's not a line. We don't give a line to the company. We actually buy from the employees. But the company has to authorize this entire process, right?
Okay.
The productization of this is in the form of a line. So the company says, okay, here's an investor who is authorized to be on our cap table at this price. And over the next 3 months, here is my formula on how I want to do this liquidity for employees. And some of them will set limits, some of them will, figure some other mechanisms out and so on.
So they dictate the pricing.
There's some more nuances here. While in some companies, you can actually buy the, employees can exercise the option, then you can buy them without the board sanctioning it or the company sanctioning it. In some companies, you need the company to sanction it. But in all scenarios, we will not buy until the board has sanctioned it, even if the employee has a contractual right to exercise the option and transfer it to us.
And the price is negotiable? Or
the price is negotiated with the
Once
company.
with the company, not with an employee on a deal by deal.
Achha. So two employees can't sell it to you at different prices?
No. I think, there are two ways.
There is no reason why it can't be that way, but we don't want to do it that way.
If I'm an employee, if I'm a disgruntled employee and I want to sell it to the highest bidder, I should be free to do so.
No, the company law prevents you from doing it, right? Private companies usually requires board approval. So if the board is going to eventually block it, then the transfer is not going to go through.
See, there are lots of nuances around this. There is an edge case where it's possible, but it's really an edge case. In a regular scenario, it is just not possible to do this.
So US, even very large financial firms like Goldman does it, right? So they go directly deal with the employee, provide the cash that is required, and then on a revenue share model whenever the employee sells. So the company doesn't even know, right? The shares remain with the employee though. It's not sold, technically it's not sold to you, but Goldman has come and provided the liquidity. And Goldman is a placeholder.
Once it becomes a share, typically there are no restrictions. So it remains as options and Goldman provides the liquidity to the employee.
I want to sort of spend a bit more time on understanding how India is different, but I want to first finish off sort of your business. So there are these three products, if you will. What is the business model?
So the software is sold to the companies and just like a SaaS product. So we have a monthly annual subscription fee on that product.
Roughly? Does it vary on the company size?
It varies on the kind of securities you have, and it varies on the number of employees you have. Number of grantees.
Say I'm a startup and I have, 20 employees to start with, and it's fairly straightforward. What would I have to pay?
Oh, if it's 20 employees, you'll probably pay next to nothing, less than $1,000 a year.
Okay.
Yeah, it'll be much less than $1,000
okay.
a year.
And then it goes up to?
It goes up depending on the size of the company. Like, for example, some companies have let's say 4,000, 5,000 employees, right? So for each employee, you pay like an annual, annual fee, depending on how many plans, and how many grants you have, anywhere between like $1 a month to $3 a month.
Okay, and how many clients do you have in this service?
So we have about 140 customers right now.
Okay.
140 paying customers.
Right. Are there non-paying customers?
There are a few people where
Free trial?
it's not free trial. It's really very early stage companies, and some funds we've signed up with. We help them with the transaction process. So we offer the solution without payment for a year, for 18 months, because it's packaged into something else.
For the funds as opposed to the companies?
Yeah, no, funds or the companies. So the company says, help us with this transaction. As part of the transaction, we, provide the software free for a particular period of time. So Satish is talking about customers who are paying specifically for the software.
What about the AI? If you mentioned you've raised,
no, even on the software, when there's negotiation of all these agreements, there's actually people pay you for the service.
I was going to actually ask you. It sounds like you have a services segment as well.
Correct. So that was the legal team and secretary team that I was talking about, right? So there is a revenue component for every transaction we get involved in, because that's more of your typical law firm type services.
Law firm and company secretarial.
Correct.
It is law firm type because we don't give legal opinion because we are a company. It is not exactly legal services. It's just helping people negotiate agreements and manage closing.
And you have a library of standardized agreements as well.
Got a lot of content
Safe
on
and
that.
all that.
Yeah.
Okay. Where has the company got to in terms of revenue?
So
this year, we will cross $1 million in revenue.
Okay. And what about capital raise? I mean, we are sitting with Rainmatter. I'm assuming, have a Rainmatter investment.
The first check came from Nitin.
First check, okay. How did you manage that? How did you reach out to Rainmatter, and why?
I think one, obviously, he was already well connected, because of his previous work with
So you're already providing some legal services.
I was part of a law firm, and that law firm was engaged with Rainmatter, and I know Nitin and Nikhil from those days. And when we pitched the idea to them, they said, "Okay, we are happy to write the check."
How much did you raise?
So total, we've raised about 25 crores over the last 3-4 years. I think Nitin's was probably one of the first checks, like I mentioned.
You now have other investors as well. Okay. And what's the ambition? Where do you want to get to?
I think, ultimately, like I said, we do want to become the engine for private market transaction. When we started, like I said, we thought the end game would be just the marketplace, right? But then now we kind of realized that, you need tech that will kind of help you get there, and then you need your own capital that will help you get there. Then the next stage would be really to produce this vibrant, marketplace. So, it sounds cliche saying NSE of private market stuff, but ultimately what we are looking at is how do you get into the center of this private market transaction? Whether it is tech, whether it is capital, whether it's, market, doesn't matter what you call it. And it's kind of evolving. So I don't know what the end form would be, but the end game is, to be the engine of that private market transactions.
There's a whole bunch of private brokers that arrange private market transactions.
Those are all largely pre-IPO stock or investment bankers who are way more sophisticated.
Is there a need for creating that ecosystem and around your software?
Ecosystem in terms of software is going to be more in terms of getting everybody to deploy digital cap tables, right? Whether it's our software or somebody else's software is we want it to be our software, but I'm saying in general.
And how many players are there in this market in India?
Right. If you take the ESOP software, there are a bunch of players, but the equity management software in the broader sense, nobody's built what we built.
Yeah, but you have Let's Venture, Trika, you have Capita, and probably one or two others in India. Katta tried to enter India and then they exited because I think the focus was there.
And Equity List.
And Equity List, which used to be part of Angel List.
I was going to say Angel List sounds like it could do something like this.
Angel List and Equity List are now two separate entities. It was Equity List does some of the software in a similar way. But I think where we truly differentiate is our cap table is, it's comprehensive. It does not, what the others have built largely is mimicking the public market depository system, right? So if you look at any company today, you have one class of shares. Equity at best if you have a DVR, and that's listed separately, right? So if you look at a typical, what we call a BenPos report that comes from your repository, you'll say shareholder A, and this many number of shares, and that's it. And a few more metadata that describes the investor, not the instrument, because the instrument is uniform. So most of them, have built a very rudimentary system, and they're focused more on ESOPs. And some of them I hear are also going down similar path of trying to build a marketplace. Trika, has a marketplace at least documented, and they have their other part, which is similar to AngelList and raising early capital. So they claim to have an investor network and so on and so forth. But largely, when it comes to software, our idea is to make sure that we track the life of every share, so the transaction can happen without any due diligence.
See, essentially, the marketplace itself is a very loose word, right? It's not a technical term. A marketplace is a place where buyers and sellers meet and transact. It can be a completely offline transaction. It can be a completely online transaction. It can be somewhere in between. What we are trying to do is build software so that and services so that the marketplace is way more efficient than it currently is. When you're trying to do a primary transaction, when you're trying to raise money for the company, you always have a window. You know that you're going to run out of cash for a certain amount of time. It takes a certain amount of time to raise money, so you can plan for it. But a secondary, when you're trying to look for liquidity for your shares, it's never like that. Especially if you're an employee or an early angel, when you need liquidity, you need it. And it can't be that you have to find buyers at that time. If I take 6 months to close a trade after that, in that period, if you find liquidity elsewhere, you're just going to take that liquidity. Whereas if you have a marketplace which is built on solid software and limited amount of services on top of it, the idea is once parties are able to agree on the principal terms, you should be able to close a transaction in a week or 10 days. See, if it's an Axel partner selling 20% of a company, it's a complicated transaction. If the whole company is getting sold, it's an M&A, it's a complicated transaction. But if an angel is selling 3/4%, if an employee is selling 5,000 or 10,000 or even 100,000 shares, it should not be complicated. But the fact is today it is.
Okay, but who are the buyers for these ESOPs? Are they other individuals typically in India, or are they?
It's our fund. We are the liquidity provider.
Okay, I was going to say, so you don't have to then market this platform to VC funds to say Axel or whoever else needs to be on this platform. At the moment, they're not, right?
No, they don't need to be. They don't need. The companies need to be on the platform for the transaction that needs to take place. So I would use the most, again, cliched stuff, right? Like it's not system of record, it's system of intelligence. If you treat all of this as system of records, then things will go offline and the old world will take over, right? At the end of the day, hey, instead of putting on an Excel sheet, just copy somewhere else, you get a nicer UI and you're done, right? I mean, there's no game there. I think the whole idea is that, every little share's life has to be taken care in the platform itself. So when you're doing the transaction, there is no separate due diligence required, and a lot of what we are trying to do in terms of tech is how do I make the transaction faster? How do I not take it off a platform where the old way takes over again?
And that needs two things. It needs the software plus standardization. If you don't have standardization, no matter what you do, it will go offline.
All right. But the fund size is one, small, but two, also I was wondering what the TAM is for people selling ESOPs. How big is that a market in India?
So pretty, simple, right? The total value today of all startups is in India is about 430 billion, give or take some number, right? If you bring it down to the Sunicon, minicons, not even the unicorns, right? Stuff, it's probably about 150 billion. The market that we want to go after is about 35 billion roughly, which is companies that are in the 75 to 250 million valuation range. And this has, out of this 35 billion, about 3 billion is in ESOPs alone. 3 billion is roughly about 3 billion is in angels, and the rest of it divided amongst the founders and institutional investors. So if you look at the fund thesis, we want to invest within this 34 billion and inside that the ESOP of about 3 billion. So that's the market. And look at our fund size. It's so tiny weeny when you look at that, right? So even if you build a marketplace within that segment itself, I think there is enough capital that can be deployed.
3 billion is the ESOP size, but many employees may hold on to their ESOPs for a very long period of time. So the proportion of people wanting to sell early would be a very small fraction of that, no?
So you've got to look at the...
Actually, just play on that same number, right? 3 billion is about 24,000 crores. 1% of that is about 240 crores. So when you look at it, the reason we also chose this 150 plus 150 number, there were enough people who said you can go and raise 500 crores on this fund, and they were ready to help us raise the money as well. But like Satish earlier said, this is the first time somebody's trying something like this. So you want a fund that you can comfortably deploy the cash on. You don't want deployment pressure. The moment you have deployment pressure, there will be mistakes you'll make as a fund manager. The key was this.
And just to finish off, the business model for the fund is like a fund, right? You're taking 2 and 20, or what is it nowadays?
Yeah, it's 2 and 20. Yeah.
It's 2 and 20.
2 and 20, a little floating, little small nuances here and there.
But broadly, it is 2 and 20.
But
2 and 20, it's correct.
But it's a shorter tenure fund. It's not like your typical 10-year fund. It's about 5 years, because we believe that we want to exit at a certain point in time.
What is it called? What is the fund called?
Hissa.
Hissa fund.
Yeah, Hissa Fund 1.
It doesn't say ESOP or something in it.
Hissa Fund 1.
So the thing is, if you...
You're ambitious.
So when you look at the life of a company, right, like Satish said earlier, it's upwards of 10 years. And, when we invest, when they're getting to this $75 to $250 million phase, it's somewhere halfway into a company's life. So our first check goes in halfway into a company's life. So we think that the fund life itself is going to be the balanced life of the company, so to speak.
Okay, so you said you raised 25 crores and you've already been in business 5 years. And you said earlier, if a company doesn't list within the first X number of years, we're not sure about the company. So what is your ambition for your company?
So that 5 years number no longer holds, right? So if you were talking to me, if you were talking to me in 99 or 2000, I would have said,
Do you have ESOPs for your employees?
Of course.
Am I buying into that?
You should. No, but when we say 5 years, like Satish also said, it also includes the ideation phase. While we set up the company, we just set it up before COVID. So almost a year and a half, all we did was spend time ideating on what we want to do.
But in terms of like revenue, you said, profit?
We're not profitable for sure. The idea of the profitability is, I think this is why I was telling you about why it makes sense to stay private longer in that sense, right? And also, we've got to remember one thing here is we are not a consumer company, or you're not a company that produces a product that's for daily or weekly use. So again, one of the flip sides of the venture world is, everybody thinks this, triple, double is possible, right? So you have to have this, 3T, 2D model to work. The problem that you are solving also has to be like that. We know this is a niche play, and we know this is going to take time. Nothing is going to happen overnight here, and we are prepared. There is nothing we can solve here by throwing money, acquiring customers. There's no such thing. The whole idea is that private markets are staying longer. Almost every stakeholder is spending a decade. And how do we solve that problem where it soon begins to get a little more, vibrant? Obviously, in no comparison to the listed market ever, right? That works in a very, very different model. But people who built these new age companies can, at the end of the day, make wealth. Otherwise the entire stuff is going to collapse. You will not see micro VCs, you will not see angel investments, and so on and so forth. So we are patient. We know it's going to take time. Profitability, obviously, if you ask me as a founder, we would love to be profitable as quickly as possible, but that's not the focus right now.
What would it take? I mean, what is it that you're hoping will go faster for you to reach profitability faster?
I think one, obviously, we need to see a full cycle. We need to see cycles of employees issuing ESOPs, managing it digitally, doing liquidity on a platform, doing multiple liquidity on a platform, and then continuing to go raise money and then going public, right?
And the investors who have bought into the liquidity getting liquidity themselves.
Yeah, I mean, that's true for any fund, because the capital that we are raising, has to be seen as pure capital.
No, I was talking about the marketplace transactions that we are doing, where we've had HNIs buy into ESOPs directly. They need to be able to sell, because us as a fund is a little longer while away, but we've done some transactions where HNIs have bought into exercised options. They also need to see liquidity.
Out of the 140 odd companies that are using your platform as a SaaS platform, how many of those are close to listing or to a liquidity event?
No, there are two things, right? Liquidity, almost close to about 15% have done liquidity. Okay. Listing, I think there may be
10% of the companies can potentially list in the next 12 to 18 months.
I think the smaller number in the next, I think there are some who have already filed for their.
Are they large enough to be listed? And whether they're ready to list are two different questions, right? So there are at least about 10% of that who are thinking of listing.
Let's talk about your own company again. So what is you're talking about the ambition, but at what point do you sort of say, okay, it's not working, we might go and do something else? You seem young enough. Maybe give us a bit of background how we discussed we're all similar age, right? And I still have ambition to do something. So I'm just curious, what's your background and what do you want to do next?
We are very, very, very far away from that. We are actually pretty energized right now, both of us, and things are really looking up at many levels for us at the company today. So I don't think we're anywhere close to being tired, though it's 5 years old.
Yeah, I've never had a plan B.
No?
This is plan A and this is plan A.
Yeah, I don't believe in plan Bs either.
How do you sort of run the company? Both of you are co-founders, and what?
So I manage the product and most of the internal operations, and he does a lot of the external stuff, which is fundraising, business and so on.
And also on the transaction side, whatever services we provide, I lead all those services. And we collaborate because, the product needs to integrate both of them. And the vision needs to be integrated, right? So, and the other thing between the two of us is we don't need to discuss a lot of things. He would have met some team members, I would have met somebody else, some interactions are going on. He gets a sense of what I'm up to. I have a sense of what he's up to at a very detailed level, not at the superficial level, right? We really don't need to talk so much, maybe because we've known each other for so long, and also maybe because we are older than your typical mid-20s founders, right? So we get each other at that level, so it's a lot easier.
But you do need to do some marketing for companies to know that you exist, right? I mean, how many sort of startups at this point know that you are there to provide a service?
So I, again, come from a school where we don't believe in your-face marketing, right? So a lot of the first set of customers that we have, like typically any startups would come from your personal connections and grow from there, right? And that's what I was telling you when we started. Like our LinkedIn presence has been fairly poor. Both of us don't tweet. We communicate very little, externally. Maybe that's something that we need to change, But otherwise, it's largely been. This is a very small ecosystem, And fortunately, our networks have been strong enough that even if people don't know the company, they will know us. So for us, it's not the initial go-to-market has not been that much of a challenge. For example, if we leave this geography and say we're going to do something else, then we need to have a lot more structured marketing and stuff like that in place. So some things, and obviously it also helps that you don't need to spend money on some of these activities.
It's the fact that you do need to, or you don't need to?
We don't need to.
Why not? I thought for marketing you'd have to.
No, that's my point. The fact that we are doing this, hacks for GTM,
right.
We are not having to spend, rather.
Of course. How many people in the team now?
We're about 40 people now.
And what sort of backgrounds are they?
So about half of them are engineers, product guys, 30% from legal and secretarial domain. And the rest of it is,
Finance and
more.
So one thing I'd like to add, this sort of permeates the entire conversation we've had till now. But if you look at oil or currencies, the value of these instruments goes up when they're sitting on an exchange. Okay, even the share, the value actually goes up when it's on the stock exchange, right? So what we are doing at a very fundamental level is trying to get the benefit of an organized structure for private market stock.
I think the value of a share goes up at listing one time, but then the returns from listed equities tend to be lower than private equity. Albeit, it's a bit of a sleight of the hand, because private equity, one, has an illiquidity premium, and two, technically tends to be leveraged. So if you adjust public market equities for leverage and the small cap effect, which private equity has, then the returns are pretty similar. So I'm not convinced by the argument that the value changes just because you're listed.
So it's not true for everybody on the cap table in the case of a private company. So the net value of the company will remain the same by and large, but there are massive discounts which early angels end up giving. Employees don't always get the right price. So in an organized market, it tends to be more fair. It tends to be more balanced. A 5% discount because you don't have liqupref, or a 10% discount or a 15% discount is one thing, but 40% discount is something else.
I've been that employee. I didn't get ESOPs. I actually bought shares and I could not sell it. For the life of me, I could not sell it. And the company was run down and to zero. So I'm technically worth zero in that. So it's like, I feel when you buy into an illiquid asset class, whether it's an AIF, whether it's a company, unlisted company, startup, the employee, young fresher, has to think long and hard about, okay, when they say to you, we are not giving you so much salary, but here's ESOPs, please take this. You really have to say, okay, is this the kind of person I would trust with my life? Because I'm having to trust with my life. My whole life now will depend on that. So having now burnt my fingers, I would say I would not take that. I now take cash every time. Give it here rather than ESOPs.
So illiquidity in private markets used to be a feature. Now it's a bug, if I were to use the software engineering terminology, right? So you got caught in the bug. If there was liquidity available, if there was third-party liquidity available, I'm sure the company would have facilitated some sort of liquidity for employees. See, because one thing is, traditionally companies have done buyback when they've been profitable. These companies are growing. Every single rupee that's in the company is used to grow the company. So you are not using that cash to liquidate anybody. You need a third party, and more than a third party, a liquidity ecosystem to develop. Saying, okay, there is some set of people, who are interested in this and can do partial liquidity. When we talk about liquidity, we always talk partial liquidity, because you don't want liquidity to a point where you eliminate that stakeholder from your cap table. That's not the idea, right? Even if it's an employee, and more so if it's an employee, you want the employee to stay longer with you. But the example that you talked about, hey, someone has come in early in the life of the company, taken a risk and taken a pay cut. Now let me make that up by allowing them to do 20% of their vested options. Let me liquidate them. And then maybe when the company is little growing, you can bring them up to market salaries and so on and so forth. I think this system does not exist, which is what we are trying to solve for.
See, liquidity should ensure that there are incentives that are aligned. When there is no liquidity, they're actually not aligned.
But if they're going to come in, they will be picking up VC stakes rather than ESOP stakes. I'm just saying that even if I were to pitch India as an investment destination and say, okay, let's bring more capital in, buying ESOPs it's very small.
No, that's at this stage. Like Satish said, if you take the entire startup market, it's in excess of $400 billion. Even if 7% of that is ESOP, You're talking about a $30 billion marketplace. You add angels, you add micro VCs to that. Suddenly the market is $60, $70 billion. So in the segment we are playing in a very, very narrow area where we want to operate at this moment with this fund. It's not very large. But if you look at the overall ecosystem and the rate at which it's growing, it is very different. And there is a play for everybody, right? There is a play for somebody who wants to buy out a micro VC. There's a play for somebody who wants to buy out a founder. There's a play for somebody who wants to give liquidity to ESOP holders. Everybody brings their value to the ecosystem. Now, when a company wants to take money from you, they're looking for value beyond the cash. So when you go to a Rainmatter, or you go to an Axel, or you go to a Sequoia, there is some value they bring, which is way beyond the money that they bring in, right?
Primary capital. This is primary capital.
Primary capital. When you talk about our capital, what we are trying to do is provide a framework where employees feel incentivized, employees see value in their ESOPs, so companies see value in the money. So it has to be just beyond the cash. That's how the private markets function.
Is there anything else that you would like to say to the regulator or anybody else in terms of making this market easier to operate in?
If there's something, I think that accredited investor concept, if that's kind of quickly built, though there is a concept now, they are giving out, this stuff for 3 years and so on. I believe it's not, well documented, well explained, and so on. I think that's an area where you could probably do stuff better, and that will better increase the flow of capital. Again, shorten the time in which you can do transactions if it's an accredited investor, and so on and so forth. That's one area. Second, obviously, is enabling this sort of a marketplace type of structure under some sort of regulation. Whether it is like a investment advisor or an exchange, we don't know what form that they would feel comfortable with, right? But something that will say, hey, I have a secondary X number of shares, I can willingly go and put it out on a platform for sale. And I'm kind of using these words very loosely, but some structure where that is possible outside of the angel investment framework. Angel investment framework is a very different, it's solving a different problem and so on. We don't intend to go and say, okay, make it retail friendly.
We don't think it's good. We don't believe it's good. Today it's prohibited. We don't want a complete, free market there. You need a framework, and we would love to see the regulator put a framework together. And to add to what Satish said about accredited investors, when accredited investors come in, because these are supposed to be more sophisticated, understand risks, some of the rules you made to protect the smaller investors should be, you need to carve out the rules in a way where an investor who knows how to protect themselves are not subject to all those regulations. One simple example, these roll-up vehicles which are used around the world, it's not easy to set up and manage roll-up vehicles in India. So, if that roll-up vehicle structure is permitted, I think there's going to be a big difference. But allow only accredited investors to come in through roll-up vehicles. Don't allow anybody else to come in. Things like that can, make a big difference.
As we wind up, any advice to other wannabe founders in the fintech space? You build companies from scratch. What should they be aware of that you can share from your learnings?
I think one, fintech or any sector that's regulated, innovation is ahead of regulation. I think you can't do too many cute things with the regulator, and I think it's unhealthy. And that's something that most people who are in this space kind of need to understand and play, by that. It's very easy. A lot of people give the example.
But how do you counter that? Say I am innovative. How do I even reach to the regulator and have to educate the regulator about?
No, it's not that. Don't do cute stuff.
Don't do cute stuff.
Being a little edgy is.
But is the regulator open to new ideas?
The regulator is open.
How? And what is the format?
No. I think there are 2-3 things here, right? One of the most common examples that's given of this innovation ahead of regulation is ride sharing. No transport department in any country knew this thing of ride sharing, right? Somebody started it, and though they were like bad incidents, in general, it was positive. Regulator identified and quickly came up with stuff. That does not apply in this case, and largely because the amount of mis-selling that happens in financial products is very high. You don't want to get this auto driver to buy Bitcoin for 10,000 rupees. You don't want somebody to spend 5,000 rupees of their,
daily margin
or income, whatever you want to call it. You're earning 30,000 rupees a month, you spend 5,000 and somebody says, it's startup mein dal do. You don't want stuff like that.
See, there is no such thing as an unregulated fintech company. A lot of founders will tell you that we found this gap in the regulations, and that is true. There will be that small gap which is not regulated. You start building your business there, but very quickly as you start hitting scale, you realize that you need to be regulated. So regulation is not a bad thing. At the end of the day, financial markets function in an efficient way simply because of regulation, right? So, you have to realize that you will be regulated. So, that's why we are very careful about the words we use: exchange, marketplace. They're all regulated activities. So we are very clear that anything we do will fit into some regulation. You have to find a way where the activity you're doing fits into some regulation. The only choice you have is, which regulator you want to be regulated by. Do you want to be regulated by SEBI or you want to be regulated by RBI?
Because why is that a choice? I mean,
not even a choice. I think
there are some activities. For example, investment, the business of making investments. You could do it through an NBFC, you could do it through an AIF. You do an AIF, it's SEBI. If you do NBFC, it's RBI. That's the only choice you have. But you have to be regulated, fair and square.
What's the last innovation in fintech that you were impressed by globally?
I think UPI.
Yeah.
Yeah. The scale at which UPI has, and this is like working systems, right? And I don't think there's anything that can...
Have you looked at the technology behind it?
Yeah.
There apparently is a system in Brazil as well that is equally good and scaled even faster.
There was something in Africa many years ago called M-Pesa.
M-Pesa is different though.
Right.
Anything else in terms of comparing Indian private markets to American private markets?
I think American private markets, obviously there is NASDAQ, which is the public stuff, and NASDAQ also has a private market stuff, right? So kind of most of the stuff when it comes to this, they tend to be a little ahead there. There are secondary funds of different types taking shape now. There's VC, GP-led secondaries, where the fund again, multiple secondary funds that are getting established, moving assets from primary fund into the secondary funds. I think in general, you see a lot more activity. I personally think that there will be liquidity in the private markets in general. So you will probably see even VC fund structures, little get, disrupted over the next 5 to 10 years.
But that begs the question, why call them private then?
Because fundamentally it's still private. It's limited number of shareholders.
Liquidity, it is never going to be free liquidity. So,
and how do you solve the price discovery problem in private markets?
See, the problem is if you don't have a priced round for a length of time, but startups by their very nature continue to raise capital. So the price discovery is always happening between the company and a institutional investor, and that sort of sets the base for what the value is. Any transaction you look at, it's usually a discount to that or a premium to that. Largely it's a discount, but there are scenarios where you have a premium to that. So the price discovery is done by the institutional investor with the company.
So therefore, listing doesn't solve the price discovery problem.
Yes, it does to an extent, but not,
Okay. On that note, thank you very much. Thank you for making the time. Thanks for coming in.
Thank you for your time.
Thank you. Thank you.